720 square foot additional. It's detached from the main home. It's an additional dwelling unit.
Okay.
2 bedroom, 1 bath, 720 square feet.
Okay. Yeah. So, I mean, you know, rentals are always great. Rent never goes down. That's a nice thing, right?
And where it's located, is what's amazing, because it's 7 minutes from Disneyland. And the fact that my brother is building it for me for, you know, 110 square feet, $110 per square feet, where the going rate is really like 250. So he's giving me a humongous discount there. So.
Oh, that's awesome. And then Airbnb, I think, would be an awesome option if the local government allows it.
If the city would allow it. They don't allow it, but either way, it's gonna cash, the full rent amount is 100% cash flow, the full rent amount, because my main property is paying the mortgage on the other one, so.
That's so cool.
Yeah, I would share that. I really was excited. I'm like, oh, I need someone to tell me that I'm not doing the right thing. Because I need someone to open my eyes if I have them closed, right?
No, I mean, obviously, you know, we've been talking for 5 minutes, so I don't have all the details, but it sounds like you've got the right idea here, and that's so cool that you had a property that you could do that on. And you know, this rings a bell though. Did we talk about this right about the time you did your education?
Not too long ago, I think I asked you about adding solar to that exact property. Adding solar, is it a smart investment to add solar to an investment property? That's what we talked about.
Yeah. Okay.
Cool. Okay, but cool. I appreciate it. Thank you. Thank you for listening.
Yeah, that's fun. That's awesome. Well, it's about that time. I think let's go ahead and get the call started here. We got a few people who have jumped on. Rosa just shared with us some of the amazing strategies she's doing that if you guys weren't on when she started talking about that, she picked up a couple of tax liens out in Indiana, $9,800, I believe, or $8,900 for the two of them. They're worth $200,000. So, you know, if all goes well with that, she's got 2 properties that she picked up at like 5% of the value of the properties. Incredible. And then she's building, sounds like near Disneyland, she's building an addition or a separate home on a property that she's already got a rental on. So it's just going to be 100% cash flow for her. I love hearing success stories from students as they're going out and applying the education. So well done, Rosa. That's awesome. Guys, welcome to the call. We didn't have a call last week. We took a little break for Thanksgiving. I am glad you're here. For those of you, I remember seeing Eugene on the challenge. Don is joining us from the challenge. He's one of our newest students. We got a handful of others that are joining us today. So hopefully we see a few more trickle in. Looks like there's about 11 or 12 of you on the call today. But I wanted to talk today about some of the most common challenges that students are facing. And Tyson and I chatted a little earlier this morning about some of the challenges that he faced. I've done some reflection today on some of the challenges that I faced in my investing career, especially early on. And then I've had an opportunity to chat with each and every one of you about kind of what you guys are facing. And one of the things that comes back, and I want to open this up to discussion, but I want to start out with just a little bit of a training here today. You know, one of the things that it always comes back to, especially with students who are yet to do a deal, right? They're just wanting to get into that first deal. They're working on getting into that first deal. A lot of you on this call, you know, meet that criteria. One of the biggest challenges you face is the ability to go out and get funding, right? To get debt partners, to get equity partners, especially those equity partners. How does that stuff work? It seems like this big, scary monster. And what I found is once you've done it, and once you've done it a couple of times, really, it's not that scary, right? It's a very easy conversation. So I want to just take some time and go over that, and then we're going to open it up. And I want to talk to you guys about the challenges that you're facing, some of the fears maybe that you're having as far as getting into real estate investing. I would love to hear from some of our newest members, like Dawn, who's on the call, you know, and others about what are the concerns that you have as getting into real estate investing and just starting fresh, right? So, but let's start with that concern of finding equity partners. Now, this is something that I think was one of my big fears until I actually did it. And I was like, oh, that's easy. And it makes sense why this guy wanted to jump into this deal. But it can be almost paralyzing, the fear of talking to somebody about raising money. So I just want to pull out of the education and some of the classes where specifically the funding deals using other people's money class, where I talk about the two magic questions, right? These questions have served me so well over my career, which is close to a decade now. And man, I've been able to raise tens of millions of dollars just simply using these two questions. So if you want to take some notes, I'm going to give you those two questions now. Then we're going to have a little chat. We may even do some role play and dive into how these questions apply to conversations. So the two questions are, did you know you could use your retirement account to invest in real estate? And the second question, now let's analyze that first question. Did you know that you could use your retirement account to invest in real estate? A lot of people don't know that. It's a simple process called self-direction. Again, we talk about that in the using other people's money class, but it's a simple process called self-direction. Here's the thing about retirement accounts. You are the owner of your retirement account. You're the director of your retirement account, right? You have a right to decide what that is indexed in. Now, you can only self-direct a retirement account if it's inactive, right? If you're not, like, for example, a lot of employers give 401ks as a benefits package. They'll give you a 401k, they'll contribute to it. Those are active 401ks. There's not much you can do with those unless you've got a very, open-minded employer. Most employers, they want you to stick with the company that they're in cahoots with because they get benefits from you having your 401k with them. However, once you leave that job, once you retire or you move on and get a different job, that account doesn't close. All those contributions, all the match that your previous employer did, it's all sitting there in an account. It's just in inactive status. Now, of course, you could take that and you could go give it to Morgan Stanley, or you could give it to whoever, and have them just do the standard plug you into mutual funds kind of thing. But that would be, that would be kind of what the average person does. And if you remember, we talk about this in speed banking. We talk about this in regards to taxes. Whenever we plug into something that's default, right? People, especially financial institutions, are always going to push us towards the thing that makes them the most money. And the basic 401k plans that these major financial institutions plug us into, they're the ones that yield us a safe return, yes, but they're also the ones where they get the most fees, they get the most commissions, et cetera, right? So now that you guys are educated investors and you're on the road to becoming educated investors, we know a little bit more, right? We know what to do with that money. And the answer that we all have is, let's go out and buy property with it, right? Let's go buy real property with it because we know we can make an incredible rate of return. So those retirement accounts can be self-directed. Now, once we self-direct the retirement accounts, a lot of times we have what's called checkbook control. So once you self-direct a retirement account, you have to put that with what's called a custodian. The custodian is just going to make sure that you're following the law, right? Because there are laws around it. They're just going to make sure that you're following the law as you go out and do transactions. So with checkbook control on your 401k, you can, for example, team up with, Tyson and go do a deal, right? And Tyson will put a contract in place saying, hey, we're partners. You get 50% of this deal. All you got to contribute is $100,000 from your 401k. You write the checkbook, you sign the contract, write the check, you sign the contract, you guys go do this deal, right? And you make $30,000 on it. I don't know. But obviously that's a much higher rate of return than your 5-6% annual in a mutual fund. So there's huge benefit there. Now, a lot of people don't know about that. So regardless of whether they answer that question, yes or no, did you know that you can use your retirement account to invest in real estate? The second question is going to be the same. If I could show you how you could double or triple your current rate of return backed by real estate, would you partner with me on my next deal? Now, breaking down that question, right? If I could show you how you could make double or triple your current rate of return, most people's money is in mutual funds, 6-7%. If I could at least double that, if not more than triple it, would you be interested in seeing what I have to say? Absolutely, right? Backed by real estate. Real estate's something tangible. It's something that's never going to be worth zero. It's always at least worth the dirt that it's built on. And you know what? Property is a non-renewable resource. We're never going to have more of it. There's only so much of this planet, and it can only be sliced up so many ways until there's no more left, right? So it is a scarce resource. It's a finite resource. It's always going to be worth something. Whereas stocks, they're indexed in businesses. And you know what? For those of you who had stock in Kmart and Sears and Blockbuster, what's that stock worth? Right? Stock can be worth zero, right? So there's, the nice thing about real estate is it's safer than the stock market. It's always going to be worth something. So basically what we're saying in that second question, if I were to show you how you could double or triple your current rate of return backed by real estate, we're saying you're going to make more and it's safer. Aren't those the two things we're worried about? Is it safe and am I going to make a decent return? If I can show you how to do both those things, would you consider partnering with me on my next deal? Absolutely, right? Very rarely do I get too much pushback to it. But I want to kind of have a simulated scenario here where we kind of dive in and go through almost a role play of how this works. Now, let's see, who can I pick on here? I'm going to pick on Eugene. Are you on the line, Eugene? Are you where you could come off mute and have a quick role play with me here?
Yes, here I am.
All right, let's do it. So I'm going to have you, don't just roll over, but maybe give me a little bit of a hard time on this, and let's work through these questions together. Okay. So I'm going to start from the very beginning. Hi, Eugene. My name's Mitch. How are you?
Oh, good. Thanks, Mitch.
It's nice to meet you today, man. So tell me about yourself. What do you do?
I'm CFO of a shipping company, and so been
That's
in
cool.
this industry for a few years.
Do you love it?
I do, but it's getting a little old. Real estate's becoming a lot more interesting.
Real estate. Well, actually, I'm in real estate, so that's awesome. Now, so you've been thinking about getting into real estate yourself?
Oh, absolutely, yeah.
Cool. What would you say are the big things that are holding you back?
Possibly I don't know too much about how to go about it, and I don't know too many of my friends who are involved in this industry, but it seems like with the markets being so unpredictable, or potentially going to be crashing soon, it seems a much safer environment to hopefully put your money.
Absolutely. Well, the nice thing is I work with people like yourself all the time. I mean, I'm someone who knows how to do it, right? I've done over 100 deals and I've been trained by experts on how to go out and do this stuff. I've got a track record, and it's an incredible thing. And oftentimes I work with people like you who, have always wanted to get into real estate, but have never really, made that jump or gone out and got the education. And sounds like, as the CFO of a company, you're probably incredibly busy and don't have a ton of time. Would I be right?
Exactly. Yeah.
Well, what would you think if potentially we could partner up on a deal?
Oh, absolutely. I mean, if you give me some information and show that it's a worthwhile deal, it's something to entertain at least.
Well, let me ask you something. Did you know that you could use your retirement account to invest in real estate?
What? Absolutely not. How's that possible? I thought you can only invest it in stocks.
Yeah, that's what most people think, right?
Are you
can
sure
only
this
put
is
it into
legal?
those mutual funds. Yeah, no, actually, it's interesting because you can use your retirement account to put into any investment category, whether that's in the stock market, which is businesses. You could put it into commodities. You could put it into real estate. You could really put it into with few exceptions, pretty much anything as long as it's considered an investment. Real estate is obviously one of the oldest investment categories that exists. So it is something that
how do you go about this then?
Well, so it's a process called self-direction, and we can totally dive into all the details on that. But I am curious, if I could show you how you could double or triple your current rate of return, if we backed up that investment with real estate, would you consider partnering with me on my next deal?
Absolutely.
Okay. So
very curious.
let me show you my little number sheet here. So here's the deal we're going to be doing. We're going to split it 50-50. The profit's 45 grand. That means at the end of this deal, if all goes to plan, you get 25,000 and I get 25,000. So, you know, we're going to put X amount into it. We're going to do all these things. Profit should be 45. Now look, maybe it'll be 40. Then you get 20 and I get 20. Maybe it'll be 60. Then you get 30 and I get 30, right? But that's how this deal is going to work. I'm gonna own half the property. Your 401k is gonna own half the property. You don't have to pull the money out. It stays in the account, and it just when the profit comes in, when we sell the house, your principal goes back in. The profit goes into your account as growth, right? And then you get to treat it as growth in your retirement account.
Right. And say what happens if the market tanks? I mean, as we know, things, it's a rumor overnight, and the next day you wake up and it's 500,000 points down. So
absolutely. No.
So I mean, how am I protected in that?
The fantastic thing about real estate is it's flexible, right? We don't have very many options. If the stock market tanks, we just lose money, right? But a fix and flip could easily be turned into a rental. And if the market tanks, people lose their jobs, which when they lose their jobs, they can't pay their mortgages. So they lose their house and their credit gets destroyed. They can't go get another mortgage. So what do? They got to live somewhere. So they rent, right? Sure. And rentals do really well in a down market. So, we're buying this house super cheap. We got a huge profit margin in it. There's a lot of room for cash flow in this thing. If the market were to turn, we just rent it out for a little while and you'd be collecting that cash flow check every single month. Well, by the way, all of your buddies who left their money in their 401ks in mutual funds, they're losing money. You'd be making a check every single month until the market comes back, which it always does. If you look at the data over the last 200 years, the market always comes back. Then we'd sell it at that point. You'd make your 22.5, I'd make my 22.5, and we'd move on to the next one, right? Worst case scenario, you make more money. You just have to be in the deal a little bit longer. So really there's no downside. The real risk here, there's always risk, right? But the major risk here is that we have to turn it into a rental instead of a flip. But
So tell me a little bit about, you talked about double and triple. So how do you achieve that?
Yeah. So what are you currently getting in your mutual funds?
On a good day, maybe 11 to 12, but more on average, I'd say anywhere between 8 and 9.
8 and 9. Okay. So let's look at 9%. Okay. Let's be a little aggressive on this. So 9% on this deal that I just showed you. We're going to make, the pro forma looks like we're going to make about 45,000 together. We're splitting it 50-50. That's 22.5 to you. That's 22.5 to me. I told you between double and triple. What's double 9%? That's 18%, right?
18, correct. Yeah.
If you're going to make $22,500 and you're only putting in $100,000 on this deal, then your rate of return is $22,500. That's a 22.5% actual rate of return, right? And we're going to knock this out in about 4 months. So actual rate of return in 4 months, 22.5%. We're looking at 12 months at 9%. We're way more than double, right?
Makes sense. Okay.
And then, if we could go 4 months, we could do 3 of those in a year. Why don't we just roll it into the next one? If all goes well, let's just roll it into the next one. Let's do that 3 times in a year, right? That's 67.5%. That's incredible.
Absolutely.
Now,
Okay,
worst case scenario, let's say something happens to me, right? We're partners on this deal. We're both going to be placed on title as the owners. So let's say something happens to me and I fall off a cliff, right? And I'm not around anymore. I move to Mexico, right? And you never hear from me again. Well, you end up with a piece of real estate that you can finish the project, you can sell it, you can rent it out, you can live in it, you can whatever you want to do to it, Eugene. So it's safer as well. You can't do that with stock. You can't do that with mutual funds. It turns and you lose money, right? Or even worse, it goes out of business like Sears, Kmart, or Blockbuster. You're just SOL, right? So with real estate, we've got options. Now, obviously, we're not signing papers today, but and I want to get a chance to kind of show you through the property. We could do a Zoom call. I could walk you through the property, or if we live close to each other, you could come walk through it with me. I want to get a chance to do that before you sign anything. And I want to send you this pro forma, all these numbers that I wrote up, so you can kind of study them and come to the same conclusion yourself. But if all of this is what I say it is this something that you'd want to jump in with me on?
Absolutely. I mean, yeah,
Okay.
this was a possibility that I wasn't ever aware of.
Yep.
Great stuff. Thank you.
All right. Well, let's set up a time to walk through the property, and then if all looks good after you lay some eyes on it, let's get the paperwork signed and do this deal together.
Betcha.
Okay. So thank you, Eugene, by the way. What did you guys pull out of that? What did you guys pull out of that conversation? And that was actually a very realistic kind of conversation as to what we have. Obviously, I didn't have real numbers sitting in front of me that I could be like, well, here's the numbers, right? But that was a very realistic flow to the conversation. Obviously a little bit staged because we were pretending, right? But you know, a lot of times a lot of the same questions come up, a lot of the same concerns come up. What did you guys pull out of that? Let's talk about it.
Well, I think you did a good job of answering questions that someone might not even have thought about. Like what happens when a company goes out of business, like Sears and Kmart and that kind of thing. Those kinds of things might not have even crossed my mind if you hadn't brought that up. So I think it's good that you're bringing up some hypothetical situations that somebody needs to think about and see how this is a better option than to just leave your money in the stock market.
There's two things. That's a good point, Don. And there's two things, and I hit these two things a lot when I'm talking to people. There's two things that makes real estate a better investment, in my opinion, than the stock market, and that is it's safer and you can make more money if you know what you're doing. Right now, not to say that if you're an expert at trading stocks, you can make a heck of a lot of money in the stock market, right? That's absolutely true. However, most people are not. Right? Most people who have 401ks, they don't even know what's going on with it. They don't know what stocks they own. They just get a statement at the end of every month saying that whether they're up or down, right? And half the time they're up and half the time they're down. So, they're not educated around that stuff. Where being an equity partner, if you're not educated, being an equity partner on a real estate transaction is going to be much more lucrative because of the way that we protect ourselves. The other thing is that it's safer. So we need to just create that we need to demonstrate that point of, hey, this is safer. Look, if you've got stock in Blockbuster when it crashed, you lost money. If you had stock in Sears when it crashed, you lost money and there was nothing you could do about it, right? But with real estate, it's never going to be worth zero. There's so many alternative options as long as you structure it right, and you can get more into that. I think one of the biggest keys is just being that educated investor, right? One of the things that I did early on in my training, we have that funding deals using other people's money class. I had a very similar class that I watched where I learned everything I know, right, about raising other people's money. And I watched that class over and over and over until I knew, like the back of my hand, every concept they were talking about. Watch these classes. There's a reason we give them to you for life. Watch them over and over and over. Remember that the currency that you're not getting anything for free. There's no such thing as a free lunch, right? But why you're here is because the currency that you want to invest as the investor is knowledge. And that's why other people will throw money at you, is because the currency you're investing is knowledge. The average person who works a job and has a 401k has no idea how to go out and do what you guys are learning how to do. So become the expert at it. And that's such an important key, right? Now, I think Rosa had a point as well. Rosa, did you want to come out and make a comment?
Yeah, yes, I think a lot of us do not know that we can make that amount of through our investing this way. I think a lot of people are not educated. I'll say I'm not educated, that we can make a lot more than, and we're lucky if we're getting 9% through the stock market. I'm sorry. But I mean, making 18 and 22%, I mean, that's information that we do not have. And I think that's why we are not doing more of it, is we're not educated. That's what I captured, is like, when you were explaining and role playing, I don't think Eugene, as a role player, right, was aware that he can make 18%,
Yeah.
right?
Yeah.
And I think that's where we're missing. A lot of people are missing out on that because they don't know.
Absolutely. Remember that you're, and this is a really good point, Rosa, that you're making here. Our job as real estate investors is not flipping houses, is not buying rental properties. Your day-to-day responsibility as a real estate investor is to create wins for other people. Right now, you got to create wins for yourself, but it's learning how to create those win-wins on a daily basis. We talk about this a lot when it comes to buying properties, right? We also talk about this a lot when it comes to raising money. Nobody's gonna, if I came to Dan and I said, hey Dan, you want to lend me $100,000, I'll give it back to you in 6 months. You write me a check for $100,000 now, I'll give you back your $100,000 in 6 months. If I don't promise him any interest, or why would he do that, right? He's either going to flat out tell me no, or he's going to be nice about it and be like, well, I'll ask my wife. She said no, right? But either way, I'm not getting that money. So we have to create a win for Dan. If we want Dan to put $100,000 in, what is he going to get out of it? Right. And also, by the way, when we're talking about what the other person's going to get out of it, sometimes it seems too good to be true. And I found the way to satisfy that niggle in the back of the person's mind of, okay, this seems too good to be true. Is there a catch? To kind of get rid of that strings attached catch feeling, tell them what you're going to be getting out of it and be very transparent. That's the best way to just lay it out all out on the table and say, here's the plan. Here's what I'm going to make. Here's what you're going to make. Let's go do this thing. What do you think? Right? That kind of cuts those strings and allows them to see, well, I'm benefiting, you're benefiting. Let's go make this money together. So showing people how you're going to make money, how they're going to make money, and they're going to make way more money hanging out with you than they are hanging out with Morgan Stanley. That's the key to it, right? Just creating that win and learning how to demonstrate that win. And I think those two questions do a lot in that regard. Now, when we dive into our off-market deals on tap class, right? We have that spreadsheet calculator. That's our short-term fix and flip calculator. That's my pitch sheet. Whenever I go to a property, whenever I've gotten far enough in the process, which is step 2, right? I get past step 1 and filter 1 into step 2 of the process, and I'm actually analyzing the deal and crunching the numbers, and it looks good. There's my pitch sheet. That's the thing, that calculator. I print it out on a nice piece of paper or PDF it, right? And send it to Eugene. And that's what we're having a conversation over is, Eugene, look at this stuff, man. Look at these numbers. I've calculated for everything. I've calculated for construction costs. I've calculated for our utilities and our taxes and all these things. And the more detailed that is, the more Eugene's going to be like, okay, yeah, these numbers pencil out, right? This makes total sense. And after, we're going to be able to sell it for this. Here's my comps, by the way, Eugene. This is why I think we're going to be able to sell it for all this. Work the math backwards. We're going to make $45,000 that we split, right? And Eugene's looking at us saying, "Yeah, it makes sense. Like this all looks solid. Why not? I mean, worst case scenario, I end up with a rental and some cash flow, right? That we're going to sell and make profit on in a few years anyway. So the upside is short-term money, 4 to 6 months, short-term return, or the downside is we make some cash flow and make the same amount of money in the back end a year or two later, right? So when you can, and it's going to take going through this, it's going to take messing it up. It's going to take stumbling over yourself and not knowing the right things to say or when to say them. And it's going to take doing that a few times where you walk away from the conversation with a no, feeling kind of dumb because you kind of we're stuttering and stumbling over what you were trying to say. It's going to take a few of those, but eventually you're going to get so good at it and get better and better at each time until you're good enough at it that someone bites. And that's all it's going to take is one to get that first deal done where you're using other people's money. So it's all about that win, right? No, good. That's a good point, Rosa. Did anybody else? I wasn't sure if I saw anybody else come off mute when I asked that question. Did anybody else have anything that they wanted to share in regard to that?
Maybe just one additional thing is, you know, to point out a bit of a negative on, you know, having your money in your 401k. I mean, those funds are managed by people. Again, there's no free lunch. There's always a fair amount of commissions that you never see that gets taken off the top. So although you get this 8-9%, I mean, you could theoretically be making a 12-13, you know, if you had the cash flow that's been paid to them for their commission. So
Right.
and maybe just another additional point to highlight.
Absolutely.
You know, there's money to be made.
Yeah, there's not 25 people in a giant corporation that needs to make their cut in the middle, right? It's me and you, Eugene. Let's go flip this house. You bring the money, I'll bring the deal and the knowledge, and let's make it happen. We make a great team, right? But being confident in that and being confident in your training. This is why, we don't do our classes live. We do our classes recorded so that you can go back and watch them over and over and over again, right? We're never done learning. And every time you watch those classes, you're going to get new stuff out of it. Now, if you're planning on doing fix and flips, my recommendation is the first time, go through all the classes, right? But the second time, if you know by then, hey, I'm doing fix and flips, the second time through, just watch the classes that pertain to fix and flips, right? You don't need to watch speed banking again if that's not going to be one of your primary things that you're setting out on. If you're just going to be doing fix and flips for a while, watch the finding deals class. You got to find a deal, right? Watch the finding deals, watch the funding deals because you got to fund your deals, and watch the fix and flip course, and watch those 2 or 3 more times until you are, tell your family about it. Talk to your sister, or your brother, or your son, or your mom, or your spouse about these, the concepts that you're learning. Run through them, learn how to explain them. Once you learn how to explain these things, it's going to become really, really easy to explain them to strangers, just like I just did with Eugene, right? I know how it's supposed to work up here. I have no question on how it's supposed to work up here. Now my only job is to get it from here to Eugene's head so that he's excited about doing it as well, right? But the only way you can be confident in expressing that is if it's solid up here. So watch those classes, right? Love it. All right, so I'm curious to hear, what are some of the struggles that you guys feel like you're facing? What are some of the things that are holding you back? What are some of the obstacles that we need to overcome? Maybe, you want to dive a little bit deeper into the funding question. That's fine too. We can take this wherever you guys want to take it. But let's, you guys are in the driver's seat.
So it's done.
Hey guys, I'll jump in.
Yeah, Jason, come on out. And then I think Jen, you, we'll go Jason and then Jen.
Okay, cool. Sorry, Jen.
Video for a second because it's getting a little laggy, so I'm gonna let it catch up.
Okay.
What's up, Jason?
Hey, everybody. I was curious about, once you have that conversation and you say, hey, well, did you know that you can use your retirement account? And then, hey, what if I could safely help you out by making double, triple? And they're like, yeah, that's awesome. Sweet. Okay, cool. Well, when you go to lay out the plan, is there a template on the inside of the course, or is there something that we can use that is safe and doesn't get us into trouble? Actually, I don't want to get in trouble.
Legal trouble, like SEC violation kind of thing.
Yeah, because isn't there? I mean, so if somebody was to go in and pull out $50K out of their real estate,
out of their 401k
or 401k, sorry, yeah. How? Yeah, I'll leave it at that. I don't want to.
Yeah. So a couple of points to pull out of that, and one correction. I'm sure you knew this, Jason. They're not pulling it out, right? They're just self-directing it. So it's still inside of that bubble of the 401k. It's not Jason that's investing in the, if you were to use your 401k and we were to go do a deal together, it's not Jason that's going to invest in that deal. It's Jason's 401k, right? Just like your 401k buys stocks. You may say, well, I've got 250,000 in my 401k. Well, no, you don't. It's the stock market actually has your 250,000. You got 250,000 worth of stock in your 401k, not cash, stock, right? So in order to self-direct, if that were your current situation, you'd have to sell that stock. Now you've got 250 cash, and we're going to go spend that. Let's say we spend all of it, 250,000 on a property. Now you've got 250,000 equity in a property that's sitting in your 401k. It's still 250,000 in value, but it's now a property that your 401k owns, just like it owned that stock. And I'm out doing all the things that need to be done to make that happen, applying my knowledge, right, and making that happen, so that we can sell it, and your 250k turns into 300k or whatever the number ends up being, right? That's just a hypothetical. But there is, now to your securities question. So there are obviously laws around using other people's money, and that's to protect people that don't know what they're doing, right? And those are the people that we're going to be talking to. So the laws are favoring the people whose money it is. And so it's important to know. Now, the laws also very much understand these strategies and allow for these strategies, but there is a path that we have to walk to stay compliant with the laws. Now, normally, if I were to go out and raise funds, right? Like, for example, if on this call, there's how many people on this call right now? About 13 of you, 14 of you on the call right now. If I were to say, guys, throw your money at me, we're going to go invest it, right? In a public forum, that's a securities violation. I can't raise money in public. I can't put an advertisement in the newspaper saying, I'm looking for the lucky person who's going to come make money with me on this deal. That's a securities violation, because you need a license in order to solicit in that way. It's called solicitation, right? If you're going to solicit in a public or group forum, you need a license. Nobody that I know of on this call has a license, an SEC license, right? Or a securities license. So we can still operate in the way that I'm talking about, but there's some important rules. Now, there's a section, just for your guys' review, there's a section, I want to make sure, let's see, it keeps kicking me out here, of my own education. I keep getting kicked out. Let's see. I
think it's section 8D.
Self-directed retirement funds, module 8. Yes, thank you. You're on the ball, Eugene. I love it. So in section 8, I talk about some of those laws. Now, some of the important things. First off, like I said, you have to have one-on-one conversations. If you don't have a securities license, you cannot solicit to groups or publicly solicit. It's got to be one-on-one telephone conversations or belly-to-belly conversations or text conversations, right? Individually. So, some of you have reached out to me and said, hey, I've got a little bit of money here or there. I'd love to partner up. And rather than having those conversations over our group chat or, on this call, we have those conversations one-on-one. So it has to be a one-on-one conversation. The other thing is understanding the relationships. I know this sounds funny, but just simply calling somebody the wrong thing, it could be a violation, an SEC violation, which could lead to jail time. You don't want that. I don't want that for you. So here's some basic rules to follow as you're doing that. Anybody that's going to lend you money on a debt relationship, that means they lend you the money, regardless of how the deal does, you have to pay them back the full amount plus interest. That's borrowing, right? You've got a lender-borrower relationship where you're the borrower, they're the lender, and that's what you call them. You call them the lender. They're not your investor, because if you call them your investor, that's an SEC violation. It's even more important not to use that word in the equity partner relationship, right? For example, what we've been talking about where I did the role play with Eugene. Eugene was going to bring some of his 401k money, and his 401k money was going to be my partner. We're both going to be owners contractually in the property, right? Eugene's not my investor. I'm the investor in that relationship. And a lot of times, as we dive into the education and talk about how to structure the funding on these deals to stay safe, we talk a lot about the debt equity blend. That's a strategy that I use on a daily basis. The debt equity blend, I've got a lender, a debt relationship with somebody, I've got a lender, and I've got a partner, an equity partner, right? Someone who brings equity to the relationship, where they're not lending me the money, they're partnering with me on the deal. I'm the investor, I've got a lender, and I've got a partner. Those are the terminologies that we have to use to stay safe. Okay. So your equity partner is a partner, your debt lender is a lender, you're the investor. The person putting the knowledge in, the person actually managing the deal, that's the investor. Those monikers are okay. Stick to those things, right? But as soon as you start calling the people who give you money to go do these deals investors, that's where you've got a problem and you need a securities license, right? And you're in violation. So very, very important. And I'm glad you asked that question. There are a few things that can keep us safe. Also, you've got to be honest with them. If you're losing money, you got to say it. You got to tell them. If you're not honest with them, then you're in violation, right? It's okay to lose money. There's no law that says that you've got to make money on every deal. And that's part of the risk that you understand. It's okay. And we put strategy in place. We educate a lot around how not to lose money, right? By having exit strategies. Rosa and I were talking about this at the beginning of the call, making sure we have those alternate exit strategies in place so that we don't lose money, right? I'd rather have a flip become a rental and we still make money on the rental and eventually sell the rental and make the money that we originally were planning on making, plus all the cash flow that we made in the interim. I'd much rather have that and have Eugene stick around when he thought he was only going to be sticking around for 5 months, have him stick around for 2-3 years, right? I'd much rather have that than have to make a phone call to Eugene and say, dude, I'm sorry, I lost 50 grand out of your 250,000, or I lost 50 grand out of your 100,000, right? That's a crappy phone call to have to make. You don't want to make that phone call. So make sure you have your exit strategies in place, but you also have to be honest. If you lost money, tell them you lost money. Now, totally up to you. Contractually, you don't have to do this as long as your contracts state that they participate in the loss as well as the gain. But one thing that I would do just because of my own conscience is if I were to lose money on a deal, I would work to make that person whole. I'd take a percentage of the profit out of each of my future deals and pay it back to them until we've got them completely paid back, right? So now, that's up to you whether or not that's something you do legally, and even I would say contractually. You don't have to do that. They signed up for it. They participate in the loss with you, but you do have to be communicative. You do have to tell the truth, right? And let them know if things went south. So those are the biggest things, Jason. I think that covers the bases. Obviously, the law is much more robust than what I went into, but those, I would say that's a good, solid starting place, just to make sure that you're keeping yourself in line and in check with what the law is. Does that line up with, does that answer your question? Does that line up with what your question was? Okay, fantastic.
I have a follow-up question for you.
Yeah, shoot.
Obviously, when you're resolving concerns, it's better to resolve them before they even come up in case it comes up. So when you're resolving the concern, what if we lose money? What if the deal loses money? How do you approach that, and what do you say? Yeah,
that's a really good question. So again, it comes back to being educated, right? It comes back to the idea of that's the currency that you're putting in. And the more educated you are, the better you're going to be able to represent that, right? So knowing, look, it's your job to make sure that these deals turn out positive, and it's your job to be educated. So if you have to do that anyway, you might as well educate yourself to a point where you can explain it to someone else. We talk a lot about, the debt equity blend and how that keeps us safe. I've had people criticize me about the debt equity blend before, right? That didn't quite understand it, but just knew that I raised a third of my deals in equity. And they're like, dude, you're giving away way too much profit. And my answer is, look, it keeps me safe. I'd rather give away more profit on one deal and just go out and do another 2, 3, 4, 5 deals and make more money that way than risk structuring my deals 100% debt and then have something bad happen to the market or to the deal where I ended up losing my shorts on it, right? And having to go bankrupt or any of those things. So it's a matter of just being educated enough to be able to explain these strategies to other people. I think starting with being able to explain, look, the debt equity blend, I think just a solid understanding of how that works and going back, and that's just one module in the funding other people's money. If you go back and watch that one module, I think it's like a half hour long. Watch that 8-9 times, seriously, over the next few weeks. Watch that once a day, right? And get so familiar with that strategy and practice teaching it to other people. Practice telling your wife or your husband. Practice telling your kids. Practice telling your parents. Practice telling your coworkers. Get to a point where you can explain that that strategy really well, because that is the thing. Structuring the money and how we structure that is the thing that keeps us safe. And so the answer to that, Tyson, is in the strategy, right? If we can explain the strategy well, it's going to be self-evident that their money's going to be protected. Does that answer your question?
See that? Do you try again from a different angle, or just say, you're really sketched out, I'd rather not work with you?
Yeah. Look, hey, I've got people all the time that I talk to, and we talk about this in the course, right? You got to become, you have to become a lover of the word no, right? Because no just means that you're one step closer to a yes. We're going to get no's all the time. I still get no's, and that's fine. We get no's from people and move on. One thing that I do always ask if I get a no, like for example, if Eugene were to be like, sounds good, but I'm just too scared, right? I like the way that I do it because I'm familiar with it and I'm used to it, and it gives me this sense of security. In the back of my head, I'm thinking, well, geez, Eugene, you're an idiot because you're making 9% over here, and I could be making you 60% if we went and did 3 deals this year. But I don't say that out loud, right? I say, hey, I totally respect that. It's your money. You get to do with it what you want to do with it. But do you know anybody that would be interested in making these kinds of returns on a deal? And more often than not, I get a positive response to that. Eugene saying, hey, yeah, absolutely. My brother, he's got a little higher risk tolerance than I do. He's been wanting to get into real estate. We've been talking about it for years. Here's his number. Go call him. Absolutely. And I'll say, well, could you shoot him a text and let him know I'll be calling? Absolutely. I always try to take, even if I get a no, which could be construed as a negative, I always try to take that negative and turn it into a positive by getting a referral out of it. And that just broadens my base, right? Good question.
Thank you. That was useful to me because I was trying to raise money for a deal, and I talked to my sister and her husband, and after explaining it, which I thought I did a good job, they were like, but this is really scary and I don't think I want to do it. And then I was like, okay,
yeah,
you're an idiot.
There's 3 reasons people hold themselves back from success, right? Fear. And the first reason is ignorance. The second reason is laziness. And the third and most common reason is fear, right? You could explain it till you're blue in the face and they could have a perfect understanding of it, but still not do it just simply because they're scared. And, we can make them feel as comfortable as possible. And most reasonable people will look at the numbers. They'll allow you to walk them through it. The last questions, they'll give you a chance to answer their questions and answer their concerns. And the more educated you are, the more equipped you're going to be to do that. And then once you come to a reasonable resolution of those fears, then they'll say, well, let's give it a shot. Right. And a lot of times their first time around, if they've got $100,000 in the bank, they're not going to throw all $100,000 at you. They may throw 30 at you. Right. But hey, that's $30,000 closer to our goal for the property, for the money raised on the property. So, and then you do a good job on this first property, they'll come back and they'll throw all, you bring them, they give you 30, you bring them back 35. You just proved to them you can do it. Right. So now they're going to give you all 100 and you can go out and do properties over and over and over again. So, but with that said, Tyson, you hit up your sister. She said no because she was scared. Did you ask for a referral?
I didn't think to.
Okay. So here's exactly an action step for you. Okay. I'm going to give you the exact script. So you call her back. How long ago did you talk to her about it?
It was like 2 months ago.
2 months ago. Okay. You call her back and you say, hey, I know you, Tyson, you've always got deals in the pipeline. So this isn't going to be far from the truth for you. But you call her back, you say, hey, I've got another deal in the pipeline. I'm just wondering if you had changed your mind since last time we talked. This one's sweet. It's going to make, $40,000 total. You bring your money to the table. I'm going to give you X% of the deal. That's, if all goes well and we make what we think we're going to make on it, this is how much your take's going to be. What do you think? If you change your mind at all, she'll probably say no, right? Maybe she might have some questions. Maybe she has changed her mind. But if she says no, say, well, that's just fine. Do you know anybody who'd want to make that money in your place? Right? First of all, that makes them think, right? Wait, they're going to make my money? No, I want to make my money, right? So it kind of gets them thinking a little bit. But also, it's asking for a referral. Do you know anybody that wants to make this money? There's money to be made here. Do you know anybody that wants to make it, right? And then she'll think about it for a second, and more likely than not, in my experience, she'll give you a referral.
That's good. Thanks.
Yeah, you got it. Absolutely. All right, Jen. I think, sorry, you had a question too. Let's jump to Jen. How are you?
So I'm good. How about you?
Good.
So first I want to say that was a great role play. You guys did a great job. But then my question was, after we get through the conversation of them maybe partnering up on a deal, when we start to talk about the second deal, how do you present that? Like, is it tax-free if they just roll it into the next deal? If they roll like their profits in or roll more money into the next deal, like, is it completely tax-free to them?
No. So that would only be in the case of a 1031 exchange. So a 1031 exchange they have to do through, I wouldn't recommend doing one unless you have your accountant involved. And it has to be their name that was on the title. So in a lot of cases, that's not the case. Normally how I structure it is with partners I've been working with for a long time, we have LLCs together, right? Which that LLC could roll it into a 1031 and roll it into another property. But starting out, and in that first and second and third deal, normally we're going to do joint venture agreements where they're tied contractually and with a notice of interest on title. But it's my LLC that's on title, right? They're just tied through a notice of interest and a joint venture agreement, which is a contract, which is legally binding. But there are a couple of things that wouldn't allow for a 1031 exchange on a flip. First of all, you have to have owned the property for 2 years or more, right? So in order to execute a 1031 exchange, you have to own it for 2 years. Normally, good flips don't last that long, right? So that's going to preclude them from being able to roll their money one to another on a flip basis. Now, if you guys were doing rentals together and you had one tied up for 5 years and it was in an LLC that you will both have interest in, yeah, you could 1031 into the next one and defer those taxes. But a flip is treated differently. And we talk about in the tax basics class, we talk about, how to structure them in ways where you can treat that as ordinary income versus capital gains income, which is going to help you on taxes. But the 1031 exchange rule doesn't apply there for those reasons that I shared.
Yeah, that makes sense. No, I just was wondering because I thought maybe it was like a leverage, to sell the second or the third deal, that's all. But thank you.
Yep, absolutely. Yeah, the nice thing is they don't have to pay tax on the capital you give back to them. So if they give you $100,000 and you give them back $110,000 at the end of the deal, they only have to pay tax on the $10,000. They don't have to pay tax obviously on the other $100,000 because they should have either already paid tax or it's in a 401k where they haven't had to pay tax yet on it.
All right, thank you.
Absolutely. Now the tax question, I mean, that's a loaded question, right? Because if you're putting that based on whether it's a traditional 401k or IRA or a Roth 401k or IRA, the profit is also treated differently, than it would be if it was your individual person that you were, that you were running that money out of. So it really, we're playing at a level now where accountants have to be a part of the equation because we're not accountants, we're investors. It's not our job to be the accountants. It's our job to be the investors. Let's bring in an accountant to do that role, right?
Right.
Very important as we're talking that tax question. There's so many moving parts when it comes to the tax law. It's your job to be educated around it, right? To go through the classes like the class that I have on it. And heck, I mean, you can never have enough of that second currency. Go take some other tax classes as it relates to real estate investing and learn the strategies that can be done, but then have your accountant execute it.
Got it.
Really
Sounds
good
good.
question. I love it. There was
Hey,
someone else.
Mitch.
Dan, Dan the man.
I was just going to say, one other little part in your discussion and working with somebody, talking to them in the role play, is that they could bring that up, like Jen's inquiring, well, can you get a tax benefit, this, that, whatever. Well, bottom line is, if they make 20 grand off of a real estate deal, yes, they're going to have to pay taxes on that. But the same is true, everyone's money that's sitting in the stock market, right? If they're going to get a gain, they're going to have to pay taxes on that as well. It's not like you don't pay taxes in the stock and you do on real estate. No, you're
A really
any
good point.
income you make, the government's going to get their little greedy hands on a portion of it. And that's the way life is. So,
Yeah.
so it's not, it's even Steven in the sense that, hey, whether you make your money in the stock market or whether you make your money over here, you're still going to have to pay tax. But with the real estate, you can make more. So why wouldn't you go that way, right?
Absolutely. Yeah. Too many people get so caught up, and that's such a great point. I appreciate you bringing that point out. Too many people get so caught up, and this happens with potential equity partners, right? They get so caught up in the idea that they've got to pay taxes that they almost would rather not make money so that they don't have to pay taxes. And that doesn't make any sense to me, right? Because you're cutting off your nose to spite your face, right? Like I'm not going to make money so that I don't have to pay taxes on them. Nah, pay your fair share of taxes. Understand the tax law so that you know what your fair share is. Because a lot of times it's not a third like you think it is. You can take deductions and you can get that guy all the way down to, a few points that you end up having to pay on the money that you've made, legally, morally, and ethically, right? So be educated about it, but don't prevent yourself from going and making more money just so that you won't have to pay taxes on that money. That's silly. Absolutely. No, I appreciate the point. I used to call Uncle Sam my unexpected partner, right? He's always the one there standing at the end. He didn't do anything. He didn't do anything in the deal, but he's standing there at the end wanting his cut, right? So yeah, you gotta watch out for that unexpected partner, the IRS, right?
Hey, Mitch, it's called tax strategies and tax planning. That's what everybody needs to do.
Yep, absolutely. In fact, with I talk about as we talk in the mindset class about utilizing other professionals to do the things that aren't what an investor does. I talk about how anytime I interview a professional, one of my first questions is, and this is a deal breaker for me. Have you worked with real estate investors before? My accountant, my attorney, any of those people, right? Any of my professionals, my financial planners, any of those people, have you worked with real estate investors before? If the answer is no, my real estate agents, my real estate brokers, all of them, if the answer is no, I don't work with them. It's not my job to train these people on how to work with real estate investors. And usually what I'm doing freaks them the heck out, right? So I don't want anything to do with that process. I'll let other people be their guinea pigs. My accountant, that was the first question I asked him. He said, absolutely. I've done this, this, and this, and this. I've worked with investors for 20 years. I've seen the rise and fall of the market. I've seen, all the things. And I said, fantastic. You're my new accountant. Congratulations. So, and then with that accountant, I meet on a Zoom call, and Tyson's there too, because he's part of my board of directors, but I call it my board meeting, and I have it once a quarter. I will have my bookkeepers. I've got two of them. I'll have my business partners. I'll have my my accountants, my attorneys. We had two of my attorneys on the last call that we did for this quarter, and we get together for 2 hours and we talk about me.
CPA
right?
as well.
That's a lot of fun because I love talking about me. But we talk about what's going on in the business, and this time we were talking about how coronavirus has affected the business and the changes we're going to make and where we're going in Q1 of 2021, right? And what our plans are. We talked about, I've consolidated some of my businesses. I used to have entities all over the place because I was doing so many different types of deals. Well, we've consolidated that. We're doing flips, rentals, and wholesales now. So my accountant was like, get these other businesses you're not using off the books, right? And that was a chance for the attorneys to be like, oh yeah, sorry, like let's get rid of those, right? So
that's what made the call so exciting, because they're like, Mitch, you're driving me crazy. Can we do something about this?
Yeah. my bookkeeper, because I'm just so focused on investing, right? I don't spend much time counting the dollars. That doesn't make me money counting my money. What makes me money is doing more deals, right? I hired somebody to count my money. So she'll always call me and be like, "You're stressing me out. Why are you doing this? You're stressing me out?" I'm glad. And I said, "You know what? I'm glad somebody's stressed about it, right? Because that means it's going to get done." So I'm focused on getting that next deal. An investor does 4 things. An investor finds properties. They find funding for properties. They negotiate with sellers of properties. They negotiate with buyers of properties, and they close on properties. That's it, right? So they're negotiating with the buyers and sellers is one thing, and then they close on properties. That's it. We do those 4 things, and that's it. Investors don't count money, right? We're not Scrooge McDuck. We're not swimming through our money bins, right? We're not accountants. We're not filing our own taxes with TurboTax. If you're an investor and you're using TurboTax, you're doing it wrong. Get an accountant, right? Attorneys, we're not attorneys. We're investors. We're not contractors. If you're strapping on a tool belt because you're thinking I'm a fix and flipper, you're wrong. You're not a contractor. You're an investor. You find deals, you fund deals, you negotiate deals, and you close on deals. And when you're done doing that, you go back to the first one and you find another deal, right? So professionals can be in place to handle all of these things, and they should. Because the truth of it is they're going to do it better than you. They have way more training and way more experience than you do. They're going to be able to do it faster. And at the end of the day, you're going to screw it up. So you're going to have to pay them anyway. So you're going to have to pay for the mistake and pay for the service to be done right. Right. So it's going to cost you more if you try to do it anyway. Let's be honest. Right. And the same applies to contractors. I saw, Kendall Stock, right, Tyson? One of our investors out in California, Richard Stock's brother.
Yes, I do. Yes, I do.
So Kendall showed me a picture one time. He's like, I thought to myself, I know I'm not supposed to be the contractor here, but I thought I could save a little bit of money. We had already spent a little bit over budget, and I thought I could save some money. So I framed up this wall and put this fireplace in. And he showed it to me knowing that he was laughing at it. The wall was like crooked and the fireplace was in kind of cattywampus, and he couldn't get it to work. So we had to hire another contractor to come rip out the wall, build a new wall, and install the fireplace correctly. It ended up costing him more. If you think it's expensive to hire professionals, try hiring an amateur. You're an amateur at everything except investing. Let's be honest, right? That's why we're here, is because you're becoming the expert in investing. Hire professionals for all the other things. Get them done right, because the more we have to divert our attention to the side, the less time we spend looking forward.
I have a question about that.
Yeah.
Right now I'm in equity partner hunting mode, and I'm trying to build that up. I have a friend who's approached me. He wants to invest in real estate with me, but he is dead set on doing his own work. He's like, yeah, like we can partner up, and I love doing my own work. I can do the plumbing, the electrical. And I was like, no, I don't want to do that. So I just want to hear what your response is to people who say that to you. And you're laughing because I think it's happened to you before too.
Do you have an old recording of the 4 pillars presentation?
I do. Yeah.
Where I talk about the 3. Yeah. Just have them watch it.
Have
it because I talk about that. I talk about the 3 types of investors: the move-in guy, the debt guy, and the educated guy. And the problems with each of those things. Now, that would be the move-in guy, right? The guy that wants to, or the guy or gal, the investor that wants to go in and do all the work themselves. The problem that I have with that type 1 investor is they've got this idea that they'll be able to make more money if they don't hire contractors, if they don't have to pay for labor, right? The example that I use when I explain that in the 4 pillars presentation is a deal where we spent $250 to buy it, $50 into fixing it up. That's $300,000. Our profit was $45,000. In fact, that's the deal I was thinking of when I was doing my role playing with Eugene. So if we look at the rehab cost of $50,000, your friend, the guy you're talking about, he's the one that comes and looks at that and says, 20 grand of that was labor, right? We could have put that 20 grand back in the profit margin and made 65 instead of 45. Right?
Right.
That's his rationale. Okay. So here's why I don't love that. So first off, it becomes a job, right? And when you're the only two working on the job, guess what? It's not going to take you 4 months. It's going to take you a year. You guys super excited about working full time for a year to split 65 grand?
I wouldn't be. However, he does summer sales and he's like, I got nothing to do all year. I want to go do my own work on the house. And I'm like,
perfect. So there's your first point. And that may be a soft point for him, right, Tyson? That may be a soft point for him. But the second point, I think, will drive this home. So if you guys do the work on every deal you do, you can do one deal at a time. And this is really the folly of the move-in guy. You can do one deal at a time. That's your scale. You've maxed out, right? But if you're using professionals to get the work done, you don't have to be there every day. If you're out finding funding, negotiating, and closing on deals, and that's all you're doing, you could line up 4 or 5 of these things. And while he's right about that one deal, if he zoomed into that one deal, yeah, but we could turn that $45,000 profit margin into a $65,000 profit margin. Great, you made an extra 20 grand. But how about instead, we hire out to professionals, let contractors do the work. It gets done better. It's more beautiful because they have more experience than we are. It gets done faster, albeit a little more expensive. We only make 45. But now, because of the extra time that Tyson and Tyson's friend has, you guys can go out and do 3 of those. 3 of them, or 4 of them, or 5 of them. But let's just say 3, right? Or let's just even say 2, Tyson. We could do two in the same amount of time. Right? If we let contractors do the work. So instead of making 65 by us doing the work, we now make 90 because we let contractors do the work, because it allows us to scale, because we stick to those 4 things. Wouldn't you rather make 90 than 65?
Yes, I think he would go for that too, because he does summer sales for alarms and he's very good at it. So I could say, hey, you could go find more deals and we can hire someone out, and then you and I can make a lot of money together that way.
Yeah.
I think he'd be excited about that.
It's a question of scalability, right? It's a question of scalability. And that's where he's caught up, is he's zoomed into the one deal and how can we make more money on this one deal, when he should be looking at it as so we're only going to make 45 on this one, but let's go do 3 or 4 of them and let's multiply that 45 grand by however many. Want to say hi? Maylee's here. Say hello.
I just wanted to say see you, but yeah, I'll say hi. Hi guys.
Hi, Maylee.
Hi, Maylee.
How are you?
So we were just talking about the moving guy. Tyson's got an equity partner that wants them to do the work because they'll save money on labor.
Mm-hmm.
He wants to do his own work, Maylee. He is like, yeah, I love doing my own work. I can just go do all of it, and then it's gonna be great. I'm like, no.
You actually have a new student. Is he on here, Ronald? Is he on here?
Ronald.
I don't see him. Wait,
I have a few students named Ronald.
Oh.
We do have a Ronald on the call. I'm not sure if he's our new student or not.
Zuckerberger.
Nope.
You're on mute, Ronald.
What's up, Ronald? Don is new though. Don's from the challenge. He's joining us today.
Oh,
so that's
cool.
awesome.
Very good.
Now,
How you doing?
Good.
Hi, Ronald. Nice to meet you.
Nice to meet you.
Nice to meet you.
let me ask, guys: is there anybody that has any questions around that? The idea of scalability, right? Like around the idea of part of the reason we don't do the work ourselves is so that we can free up our time to scale into more properties. Anybody have any thoughts or questions around that concept? Okay. Well, let's move on to another topic then. Who else wants to come out and talk about some of the challenges that they're facing, some of the concerns that they have, as you know, whatever stage of the game you're in. Let's talk about it. Let's get it resolved, because chances are everybody else is going to face that same thing. And the only reason I have the answer is because I went through it already, right? So let's talk about it.
I have a question for you, Mike. I've become pretty resourceful in finding telephone numbers for people, but what I've run into the issue that either these numbers don't exist, or people who answer the phone, you know, they just lie to you flat out. And so maybe, you know, just it's taken me a bit of by surprise. And, the moment they say, okay, this person doesn't live here, or, this, you got the wrong number type thing. How should you proceed? You say, well, do you know where these people have moved to? Or how do you sort of follow up and maybe transition into using that opportunity just to speak to these people, whoever they are? Because they clearly, because I've been very much focused on looking at recent foreclosures. So, it could be that they're in the property or they somehow are associated with that person because the number's been registered to the individual who's on the tax, bill, or, who's responsible for the taxes of that property. So maybe just some guidance or thoughts on that.
Yeah. So let me walk you through a couple of points there, a couple of talking points there. So let me walk you through kind of what I do. So first off, the way that I always introduce myself is, hi, my name's Mitch. I never say I'm a real estate investor out the gate, right? We always get to that, but I never do it out of the gate because that kind of puts me at a different, they don't think of me as an equal, right? They think of me as something different, whether that's up or down. Maybe they despise real estate investors and they think they're scum, or they're thinking, well, this guy's going to take advantage of me because he knows way more than I do. Either way, that puts me on a different playing field than most homeowners. So I always start the conversation with, hi, Frank, this is Mitch Nelson. I'm calling because my wife and I are looking to buy a home in your neighborhood, and yours really stuck out to me. Any chance you're in a position where you'd be willing to talk about selling your house? That's a very neutral. Notice I didn't lie. I didn't say I'm looking to move into your neighborhood. I said I'm looking to buy a home in your neighborhood.
That's so good.
It's a very neutral, even playing field. And I didn't say, I want to buy your house cash. Can I make you an offer? Right? That's a very in your face kind of thing. We get there eventually in the conversation, but I started at just, hey, your house really stuck out to me. Any chance you'd be in a position where you'd be open to thinking about selling it? Not to me, just open to thinking about selling it, right? Start at a very neutral level. And he says, you know what? Actually, yeah, we just got a foreclosure notice. We've got to move. So I'm very interested in selling. And that we can continue the conversation from there. At some point, probably early on, you want to say the fact that you're a real estate investor and, that you can create some benefit for him out of that situation that he's in. You can prevent the foreclosure from going on his credit, et cetera. But you start out, that opening line is the important line, right? You want to start out very neutral and very much on the same playing field as them. I found my response rate is better. Now, so that's the first point. The second point I wanted to make off of what you asked. This is what we're talking about here. It goes back to the deal spotter system, right? This is step one of the deal spotter system. We're talking lead gen, right? Lead gen is rapid fire. There are months where I go through 10,000 leads. I don't have time to try to convince people who are playing games with me that they need to take this seriously, because there are people on the list who will take it seriously. So I can push those aside. I can put them in a separate file, whatever. You come back to them later, whatever you want to do. Maybe we need to let their foreclosure date get a little closer. I'll call them again next week, right? Or I'll call them on a week where I don't have a ton of leads, or whatever the case might be. Fine. But as for right now, in the moment, I'm looking for the low-hanging fruit, right? I'm looking for those ripe apples, right? So we're just going to keep going until we get a yes. Now, back to the first point, your message has to be good, right? You've got to kind of use all the right techniques, and I go over that in the Finding Off Market Deals class, or Finding Off Market Deals. But as long as that message is good, and again, Eugene, this is a process. You're going to get better and better and better at it each time. So don't be afraid to fall flat on your face a few times, right? The other thing is in that process, right? We talk about the book Go for No and how important no is in this process, because we're going to get no's. We already know that. We're going to get more no's than we get yeses. We already know that. It's going to be a lot more no's than it's going to be yeses. We already know that. We're okay with all of that, right? So during this process, we've got to be willing to accept the no's and recognize those as steps towards the yes. Every no you get, imagine yourself taking another, foot plant towards that yes, right? Another footfall towards the yes. And every time you're getting closer and closer and closer and closer until you get that yes, you win, right? Now, early on in your career, very important thing I would say, Eugene, is start tracking your data, right? Track how many no's it takes you till you get that yes the first time around. It might be something like 300 no's, right? Maybe not that many, but maybe something like 100 no's or 150 no's. And then the second time around, maybe it's 100 no's. And then the third time around, maybe it's 90 no's, right? And then the fourth time, maybe it's 80 no's, and you flatten out around 80 no's. Then you know from that point on, it takes hearing no 80 times to get a yes. And almost without fail, that's true, right? Like the next time it'll be 72, and the next time it'll be 93, and the next time it'll be 81. And then it'll almost always fall within wherever that number is. And that number is different for everybody. And you have the ability to get better. You will get better as you practice this. Your stats will get better. But knowing the data, then we're prepared for that. You can, you got a no on your last call yesterday. Well, we're strapping in today. We know we got to get 80 of them, right? So we got 82 leads we're going to call just in case, right? And you'll eventually get that yes. That's just how it works. So I would say, based on how you structured that question, my thought is just be more okay with no. If they say no, put them in a file, throw them away, whatever, move on to the next one. Keep going.
Okay. Great.
I do have a question for you though, Eugene.
Yes.
How many leads would you say you're calling? And have you gotten yeses?
I had one gentleman, I suspected it was the owner who I was speaking to, but he sort of presented himself as a person who's also living in the house, and asked quite a number of questions. Right? Yeah, representative. And anyway, so I took it almost as the opportunity to say, I'm going to talk to you as if you are the person there. And the conversation went pretty well. And then obviously, he said, okay, I will relay the message. And but again, so obviously, if he says no, he's not who he is, then there's not too much more that I think I could have done with that. But so yesterday I followed up about 12, because I took about 2 hours break during the day, and just focused on calling that. So about, I'd say half an hour was just getting the numbers and chasing that kind of data, and then the rest of the time was sort of just spending time calling.
Yeah. But
yeah, I'm not close to the 80 yet.
Sure.
So, but again, from the data that I've got, you can easily pull up a list of 80 people, and that's just on current foreclosures in, they're like the 6 towns within a 20-minute radius from where we are. So, the population is definitely there. It's just a question of getting through that.
Yeah. One of the things, we talk about pay time. We've had plenty of trainings on what pay time is, right? For example, this call is not pay time. Is it important? Yes. Are you going to benefit from it? Absolutely. Will it help you make money at some point in the future? Yes, but it's not going to directly pay you. Right. I don't give out money on this call, right? That's just not something I do. So this call is not pay time. What pay time is, though, is exactly what you're calling, or what you're talking about, Eugene, and that is picking up the phone and dialing. It's homeowners, buyers and sellers that pay you. That's what it is. So pay time is when you're talking to buyers and sellers. That's it, right? So you're doing the right things. Now, how can we fit more pay time into the same amount of time that we've allocated to real estate investing? What I mean is, if you've set aside an hour, Eugene, for calling, but and I'm not saying you do this, I'm just picking on you a little bit, using you as an example.
Yeah.
If you say, okay, from the time of 1 p.m. to 2 p.m., this is my time to call leads, right? And 1 o'clock hits, your alarm goes off, and you're like, oh, okay, well, I gotta go get my Diet Coke, and I gotta go in the other room and grab a coaster so that it doesn't leave a ring. And so, now I've got my Diet Coke set up, and then I've got to make sure my Post-it notes and my pen, make sure my pen's out, and then, we want to make sure I've got the remote and all these things set up. Before you know it, it's 1:10 and you haven't made a single phone call yet. You're right. You're shuffling papers, and you're shredding stuff, and you're filing things, and you're bringing up your spreadsheets, and you're doing all this stuff. And now it's 1:20 and you still haven't made a call yet. Right. So really that means your pay time. And then you start making phone calls at 1:20. Right. So, and you go until 2 o'clock. right? So really your pay time was 40 minutes, not 60 minutes.
6
But,
months, yeah.
you know, we started doing things that made us feel like we were leaning towards pay time. So we counted it, right? So being honest with yourself about pay time, if it's 1 o'clock, you're going to get the Diet Coke and shuffle the papers at you know, at 1:45, right? So that at 1, you're on the phone talking to a homeowner, because that's what pays you, not shuffling the
Sure.
papers, not opening the spreadsheets, none of that stuff. Now, with that, dialing the phone, right? Every time we're done with a phone call and we pick up the phone again and we start hitting those numbers, that is not pay time. We're not talking to homeowners by dialing their number. It's only pay time when we're actually having a conversation with them. So, you know, we have to make sure there are tools out there to make that process even more slick. Tyson, what was the name when we were running Man Communities, which was kind of the previous version of Ask Mitch Anything? What was that dialer that we used? Mojo. There's a service out there. There's many. You can look at different pricing and stuff, but Mojo dialer, you can take your list. So this is what you do at 1:45, right? You take your list in a spreadsheet and you dump it into Mojo, upload it, whatever, hit the button at 1 p.m. exactly. It will dial for you. You pick up your phone, it's already ringing, right? It's ringing on the other end. The homeowner answers, you have a conversation with them, they say no, of course, right? So you hang up and immediately your phone rings, you answer it, it's ringing on the other line. It was Mojo calling you. You don't have to dial anymore. Immediately when you hang up, it rings, you hit the button,
Exactly.
and Mojo's calling the next one. So over the course of an hour, let's say we're calling 80 people, right? We fit in an extra 10. Now we can fit in 90 people because we're not taking the time between every call to look at the number. Oh, what was it? 8? Oh no, it was a 6. Oh, dang it. Erase, right? Put it back in. All that time is time that we're not spending talking to people. This is a science, right? I mean, you can get to a point where you've honed this thing down into every second is accounted for. Now, with that said, right, that's a little glimpse into maybe down the road for some of you. For you, Eugene, I think you're at that point where it's like, okay, how do I get efficient with this, right? But there's some people on the call that are still just struggling with the idea of calling other people, right? Are struggling with the idea of, what do I say and what if I say it wrong? Well, if you say it wrong, then they say no and you hang up and you dial the next one and you got to know.
Exactly.
Right?
Yeah.
But and that's fine, right? But whatever part of the process you're in, pay time is the same. You just have to get to pay time, because if you're not doing pay time, all the other stuff doesn't matter. This call doesn't matter. If you're not going to do pay time, you're wasting your time on this call, right? Because you're not going to get to the point where you're going to execute the strategies that I'm teaching you about managing contractors and, you know, picking designs and structuring money. You're not even going to get to that point if you don't do pay time.
Okay. Yep.
Right. And that wasn't just to you, Eugene. I wasn't picking on you directly. That was to everybody. But you're doing great, by the way. I mean, I'm proud of the effort that you're out there making. You're doing exactly what you should be doing. So you should be proud of that.
Thanks.
Hey, Mitch.
All right. I think we've got time for maybe one more question if anybody else wants to come out, and then we'll wrap up the night.
Mitch,
so who's that lucky person going to be? Dan?
Yeah. Hey,
What's up,
to
my
go
friend?
further with that, to get insight, right down the line what Eugene's talking about, and like you said, I think it's helping everybody. But you know what I gathered from Eugene as well is we use some of these tools, whether it's skip tracing or websites, to help us drum up, you know, phone numbers for people, and a lot of those phone numbers are old phone numbers for the same person. And, you know, maybe if you're lucky, one of them is the right phone number for the right person, right? So just asking for maybe you to elaborate a little bit more. If our students are calling, you know, we get 4 phone numbers for one person who we hope is the owner on this property. And the first one, they're like, no, I don't know who you're talking to, who you need, right? And so we go to the next one and the next one. But anyway, just your input on how to go from number to number and how to work those. If we had 4 numbers in our example, to, you know, and then when you think like Eugene said, at one point he thought he really was talking to the owner. How do you, you know, address it? And when do you say, call it a spade when they say, no, I'm not interested, or, even if they're not being forthcoming, that they're the owner. So just trying to get your input on when you're dialing numbers and you know that it's not the exact number. Does that make sense?
Yeah, couple of thoughts around that. So I'll share my style, and then I'll share Maylee's style, and recognizing that everybody kind of has their own style, right? What I've found through my years of doing this, and I'm to a point in my career where, you guys are starting out, I'm having you dial these numbers because you have to know, you've got to go through it. If you're going to manage a team of people who dials numbers, then you have to know how to do it yourself, right? I've got a team. Right, I've got a team that dials these numbers for me. But the way that I did it for years, and my years of honing that, I found that it just wasn't worth my time to have to dig and dig and dig and dig and dig to try to get one person just to tell me no. It was more worth my time just to make it a numbers game, and get to that low hanging fruit. Now, that's my style, right? Now Maylee's style is, and I really like her style. She's really good at it. I'm not good at it, right? But she's really good at it. Maylee's style is where, if she gets somebody that's not the homeowner, she'll just ask them about their house. She'll start a conversation with them, and she's really good at having bubbly conversations with people. And I'm more of a kind of executive, like cut to the chase, get to the point kind of guy, right? But she'll have a conversation with them. She'll talk to them about their house. She'll ask them if they know the person that she was trying to get a hold of. If not, that's okay. Let's talk about your house. Hey, look, I'm looking to buy a house. It could be his house or it could be your house. Let's talk about your house, right? Are you interested in selling? And, Maylee's an agent, so that adds another component. What about listing? Can I list your house for you? That kind of thing. So you can have those conversations. You can dig in and you can talk to those people about it. But for me, at the end of the day, if they're playing games with me, I don't have time for games. That wasn't one of the 4 things, right? I'm not playing games with them. If I feel like they're wasting my time, as soon as they're wasting my time, it's a click, right? And Mojo's already dialing the next number for me. I don't know, that's my style. But if if you've got more to add to that, Dan, I definitely would love to hear it.
No, I just wanted to get your input on it because I understand where Eugene's coming from, where when you're first starting out, you get 4 or 5 numbers, and maybe a couple of them are home numbers that these people used to live at. One was an old cell phone number. So you're getting all these random calls, no one's picking up, and then the people that do call, you do pick up, are like, dude, I don't know who you need, and so you're trying to get frustrated, but you just got to say, okay, I'm just that much closer to the yes. But then when you do talk to someone, you think, I think they are the owner, but they're not being straight up with me. I appreciate that input, because you're just going to say, hey, you go into your spiel about, my name's Mitch, I'm calling because my wife and I are looking for a property in your neighborhood, blah, 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 blah. And if they're like, no, not interested, then you're not going to dilly-dally around. You're going to say, okay, have a great day, and you move on to the next one, right? Where, like you said, Maylee might say, well, let's talk a little bit more. Where do you live? And they're going, oh, man, So anyway, I think it's good just to get those points of view.
There is, you brought up something that does kind of get the wheels turning a little bit. There is, we've all heard that saying, fortune favors the bold, right? Well, the nice thing about a phone is they can't track you down. They could try calling you back, don't answer it, right? So you have no reason not to be bold. And I've had a lot of success off of the philosophy of fortune favors the bold. I call it posturing up. Posture up. They're the homeowner. They're telling you they're not the homeowner. Posture up, right? So the pleasantries. Hey, my wife and I are looking to buy a home in your neighborhood. Yours really stuck out to us. It looks, it looks like it's got a lot of potential, or it looks beautiful, or base it off of the property or the situation. Would you be in a position where you might consider selling it? I'd be interested in buying it if that's the case, right? Oh, well, I'm not the homeowner, and they say some things that lead you to believe that they are the homeowner. Posture up to them. Say, hey, look, my man, I'm here trying to make a win for both of us, right? I know you're in a situation, and this is where you might use what you know about them to posture up. I know you're in a situation where you're going to lose your house. I'm here to help, right? I can prevent that foreclosure going on your credit, but it's going to require that we be honest to each other. So I get the gut feeling that you're the homeowner. I want to work with you. Believe me, you want to work with me and you want to hear what I have to say. But if we're going to have a conversation about it, we got to be straight up with each other. Is that fair? And either they're going to go one way or the other. They're going to go off the handle, or they're going to, well, you know what? Yeah, you're right. That is fair. I was just worried that you were some weirdo, right? But sounds like you're a pretty straight up guy. Honestly, I get the positive response more than I get the negative response when I posture up. So posturing up, if you're feeling, and really it's case by case, right? If your gut's telling you this guy's wasting your time, get off the phone, then get off the phone. If your gut's telling you posture up, right? Then posture up. Say, look, you're telling me you're not the homeowner. I think you're the homeowner. I know what situation you're in. I'm calling because I'm an investor. I want to help you, right? I've got a win-win proposal for you, but we got to be straight up with each other if we're going to have a decent conversation here. So let's be straight up with each other. I can prevent this foreclosure from going on your credit, but I need to know, do you want to talk about selling me your house or not? You know, that kind of thing. I'd say follow your gut on that. I've you know, every time I've used that scenario, I've followed my instincts and it usually hasn't let me down. So a couple times it has, but for the most part, it's usually been a positive thing. So there are those times, right?
Yeah,
there are those times. But
great.
follow your instincts.
That's exactly what I wanted to hear, and I think that helps all the students to say, okay, I got to follow my gut, but a lot of times you do call them out and say, look, whether you're the owner or not, I really do want to help you if you are the owner. And so I, you know, be straight up with me, you know, and I think that's a great idea. It's awesome.
Yeah. Yep. All right, good call. Well, we are half past. We're actually 2 minutes over. So guys, it's been a pleasure. I love hearing about what's going on in your lives. I love these days where we get to just kind of connect, and you guys get to tell me what you want to hear, right? We have, I'm not going to announce it yet because I'm still trying to make sure that they're going to be available, but I'm going to try to get you a guest speaker for next week. So you know, we'll be making that announcement over text if it happens. If not, it'll be me, and I'll have some awesome content prepared for you. But I look forward to seeing you guys next week. Thank you for your participation today. I know I'm happy to see all your smiling faces, even though we took last week off for the challenge. But I will see you guys back here next week, same time, same place, same link. In the meantime, feel free to reach out to me or Dan. If you guys have any questions about what's going on in your real estate investing business, we're always here for you guys. So whatever you need, we're here to help. We're just a phone call or a text message away, right? Or an email, whatever you prefer. In the meantime, I love you guys. Make sure you stay safe, stay healthy, protect yourselves out there. Coronavirus is crazy right now. So just make sure you're protecting yourself, and I will see you guys on Tuesday. Thank you very much. Have a great night. See you later.
Cheers. Bye-bye.